You are all to focus on your own cases to summarize and finalize the presentation, but I hope that what we are going to discuss today together will help you to finish and make the finishing touches to your presentations. So maybe we can turn on the light, or you can need some light over there. Can you see your notebooks? So we start with problem 6 that we couldn't finish yesterday. It is actually a very short exercise presenting a company for 4 years from 2017 to 2020, and as the first thing it requires us to perform a horizontal trend analysis. Now you remember that when we have to perform a horizontal analysis, and if we have more than 2 years of data, we use a different technique from that we generally use when we have only 2 years of information. So in this case, we are going to calculate what we know as trend percentages. The trend percentages take the first year as the base year, so the trend percentages method or technique considers the first year in the time horizon as the base year and signs or puts on 100% on all the items presented for that year. So the first thing that we need to do is that when we are analyzing this 4-year time horizon, we consider 2017 to be our initiating year, our normal activity year, our base year. So everything in 2017 will be considered 100%. So we can easily, as a first step, put 100% in all of the items over here. We want to compare every item sales, cost of sales, net income, and units that are delivered to our customers. We want to see that trend over the years, but thank you. Grazie.
Guardo prima. Quella?
Sì. We can, possiamo...
Andare avanti, tranquillo. Sì, sì.
Okay. So what I was saying is that we are interested to look at the trend of these items over the year, and we consider that the normal basis of operation for everything is 2017. Maybe that is not true actually in reality for this company. If we were in the position of being an internal analyst, not an external analyst like we are now, maybe we would judge differently. But given the constraints of performing an analysis from the outside of the company like we are now, we have to consider a base year, a normal year of operations. And usually, this base year is the very first year in the time horizon. So just easily consider the first step to be this one. Everything in 2017 is going to be considered as 100%. That is our normal step of operations. Let's see how many, okay, we are good. Then the second step in the trend percentages method, this is the first step over here. The second step is that we calculate the percentages of each item over the years by comparing that value to that of the base year. That means, for example, sales in 2018 versus sales in 2017, of course, multiplied by 100, that would give me the percentage of I, of course, have done the calculation previously, give us a percentage of 92%. So we can easily compare 25,000 euro in 2018 with the amount of sales in 2017, which is 13,000 euro over here. And we have this percentage, 192%, that we can put in this cell over here. So I'm just inserting the value. Now the calculations are really basic. If we were in an Excel file, it would be very easy to calculate and compare the items with each other. You can see that we can provide information how the sales have changed from 2017 to 2018. And we see that the percentage or the index of sales is 192%. That means we have an increase of 92% from one year to the other. If we were in the simple horizontal analysis, when we simply calculate two values, we would derive a percentage, a difference in percentage by 92%. So the same information is derived in this kind of technique, but this allows us to compare more years with each other, not only two. I don't know if the calculation is clear or I need to explain further. Then we do the same with the other years. For example, we compare sales of 2019 again to sales of 2017. So the calculation and comparison is always to that of the base year, not to the previous year. This is the best thing that we can get from trend analysis, this technique that is applied here. So the next step is to compare sales of 2019 to sales of 2017, and finally, the last year, sales of 2020 to sales of 2017. Any question that I can answer for you? Something that we can clarify? Is it okay? So in this kind of technique, what we are trying to say is that we do not compare each year with the previous one, because if we did that, we don't need a new technique to do that. We simply have the previous technique that you are using already in your group work project. We compare each year with themselves or with the previous one. In this kind of technique, we consider a base year, and in this case is 2017. And this is like the normal year of operations. I need to know what happens in the other years compared to the base year. But also, by comparing to the same criteria, 2017, I can have an idea of how the year's operations are also comparable to each other. Let me explain better. If we calculate the percentages of sales of 2019 to 2017, we have a result like 315%. Of course, this is compared to 2017, but I can have an idea how we have improved and increased sales also compared to 2018. So you see that we start from 100%, which is the base activity, the normal activity. We jump at 192%, and then we have 315%. We can have an idea of comparing with the base year, of course, but also to the previous year, which is 2018. We can see an increase from 192% to 315% over here. And finally, if we do the last calculation, comparing the sales of 2020 with the sales of 2017, we have a percentage, 469%. That means that we see we have an ever-increasing trend in sales, and we can compare all the years to our basis normal operations, 2017, but also we can compare years with each other. Okay, so whenever you see, maybe there are examples in your own annual reports of your own companies. The companies may have represented data over 5 or 6 years, and sometimes in percentage. If you have information for more than 2 years, usually the technique that is followed is this one. So you have everything compared to the base year or to the first year in the time horizon over there. Usually it is not compared to the previous year, because if I just compare years with each other, we will lose sight of what is the basis or the normal base of operations that we decided is 2017. So if I compare 2020 with 2019, and then 2019 with 2018, I would lose sight of what is the normal operation for me. We may have variation from one year to the other, and that is not captured by the simple horizontal analysis that we apply when we have only 2 years of information. So whenever you have 3, 4, or more years of data, please try to use this technique because this is more accurate from a statistical point of view. You just select the basis normal operation year, that is usually the first year in the time span, and then you compare every year to that base year for every item. And so you can have an idea what is going on with the sales. Obviously, for example, the sales have been increasing and in a very considerable, very extensive percentage. It's a huge increase from 2017 to 2020. They have increased for more than 4 times, from 100% to 469%. Any question about how we perform the calculations? We can do the same with the other items. For example, cost of sales in 2018 will be compared with cost of sales with 2017. And if we can make that calculation, we find out that that percentage is 191% over here. So it is almost the same change as the sales. Usually we expect sales and cost of sales to change with the same percentage from one year to the other. Why is that so? Let me ask you. Because that is helpful when you interpret your amounts in your group work project. Again, I'm repeating. We usually expect sales and cost of sales to change together at the same direction and with the same rate. Why is that so? Why do we expect this? Any idea? Just a rough idea you might have? Because something that goes out of the normal expectations, I need to explain. In this case, there is nothing to worry about. Sales and cost of sales are moving both of them in the same direction with the same percentage. Sales have been increased by 92% and cost of sales by 91%. Why is that normal? So I can be attentive to what is not normal later.
If the firm is in some situation of growth, is growing, it's normal that all of the costs and sales are going to increase in the years. And if it's not growing, but it's maybe declining or it's not maturing, it's different.
Okay, I'm expressing that because I'm more of a number person. I'm expressing that with a formula. Usually we calculate sales as the production of the price, selling price of the product multiplied with the volume of trade or the quantity. Of course, that is difficult to measure when we have more than one product with different prices. But basically this is like the equation. The sales revenue is the multiplication between the price and the volume or the quantity that we have sold in the market. Whereas the cost of sales is the product between 2 other components, which is the unit cost multiplied with the volume again. So remember that the cost of sales is the same quantity of inventory that I have sold in the market. How much did it cost? How much revenue did I get from selling that? That is measured and expressed through the sales revenue, and compared to how much did that cost in the first place. This unit cost over here can be either the unit cost of the purchases if it is a merchandising company, or the unit cost of production if it is a manufacturing company. The unit cost of production, remember, includes direct materials, direct labor, and conversion costs. Whatever this is, we usually expect that under normal courses of operations, being one of the factors the same, so the volume is the same in both sales and cost of sales. What changes between them is the selling price and the unit cost. Now remember, the unit cost may be very well the purchase price in case of merchandising companies. So in normal conditions, I expect that if I have an increase in the price of the raw material, I will have an increase in the price of the finished goods as well. So I expect both the price and the unit cost to move together and preferably at the same rate. That means that these two items in the income statement are supposed to move in the same way and with the same rate, because the volume is the same in both of them, and for the other component, which is the price, for the sales is the selling price and for the cost of sales is the purchase price. Again, under normal conditions, I'm expecting them to have the same trend. Either we have inflation and both are increasing, or we have a deflation and they are both decreasing. So basically we are expecting them to move along. Is that always true? Not always. In many instances, we will have different changes in prices and unit costs due to variations in other items of unit cost, like direct labor costs may go up or down, or also conversion costs that are related to the capacity, normal capacity. So be prepared to understand the movement of these two items and to see what has had the greatest impact. If you see that they move together, then the volume has had the greatest impact because it has made and pushed these two items in the same direction at the same step, at the same rate. But if you see that they are not moving at the same rate, then the factor that has impacted most is not the volume but the price, either the selling price or the purchase price, the unit cost. I don't know if that is clear, but if we calculate the further percentages, we may comment further on that. If we calculate the percentage of cost of sales 2019 compared to 2017, which have 313%, and for 2020, the percentage of change, the percentage compared to the base year will be 459%. Now, this is a little bit more clear. Again, in 2019, we have almost the same trend at the same rate between sales and cost of sales, so nothing to say about 2018. Whereas for 2019, of course, they are very, very, very close together, but there is a 10% change between them. So we can say that the company has made it to be able to increase the sales more than cost of sales. And what is that? What that could be due to? That could be due to the increase in the selling price more than the increase in the unit cost. That is that the reason why we have a higher increase in the sales revenue is because we are increasing the prices of selling the product higher than increasing the unit cost of either purchasing or producing. So you always compare the changes or the trend percentages in this case between the two first items in the income statement, and then you try to understand what has been increasing more and is that good or not good for the performance of the company. In this case, we have a successful company. It has been increasing at a very considerable rate from one year to the other, and especially it has managed to keep its costs under control. So it has managed to increase more the sales revenue rather than the cost associated to sales. Now, before we jump to early conclusions, let's see what the net income changes from one year to the other. That is because the cost of sales is only the first line of expenditures. Of course, it's the highest. For most companies, you may have found that the cost of sales represent between 70 and 85% of total revenues usually. So this is like the highest expenditure item for many companies. But also the operating expenditure can be higher, can be increasing a lot. So they will also have an impact on the net income. So let's see what happens with the net income over the years. After all, don't forget that the most important item of the financial statements of all the annual report that you are reading is exactly this one, the net income. Before we go and analyze and calculate tens of ratios that we are actually doing, the first thing that a shareholder, a potential shareholder can do is to check if we have a profit or a loss. So the first thing, the most important item that we are interested in and we want to analyze and explain why is the net income. Either we have a net income or a net loss, and what has happened with the net income. Are we increasing this item and why? Or is it been decreasing and why? Can we explain that and can we do something to change this reality? So don't forget that the net income is very important. So if we calculate the percentages of the net income, I'm not sure if we all understand how the calculations are done. Yes, Gloria, thank you. Again, we compare 2018 to 2017. We will have a percentage 193%. If we compare 2019 with 2017, we have 321% compared to the base year, but we also, you can see, we can also compare to the activity of the previous year. So this kind of technique allows me two things, to be compared to a normal basis of operations and also to the previous year. Why is that good for us? Sometimes comparing to the previous year, it's not a good idea. Let me take a clear example. Now, most of you have had, some of you, not most of you, have had the annual reports of 2021, not 2020, right, in your group projects. How many of the groups or companies have reported 2021? That depends on the financial year, right? Good. So that means that you are comparing to 2020. Now let's assume the next year comes and other students will be forced to compare 2021 as the calendar year with 2020, which was not a normal year. So under the normal comparison technique, horizontal analysis that you are following, you would be comparing 2021 with 2020, which is a terrible year, and comparing to a terrible year, everything would look very good. So this is not a very good basis of comparison. What I'm trying to say here is that the simple horizontal analysis that you apply for your group work presentations is not the best one, because you are forced to be compared or to use as a benchmark the previous year's operations. That is not always feasible, that is not always good to do, because the previous year, maybe it's not a very good year for the company, like 2020, or it may be a year with abnormal operations. For example, one company might have many discontinued operations, so it's not good to compare one normal year activity with some year when we've had discontinuation of many activities, if you can get the idea. So I'm trying to push you that whenever it is possible, try to include as many years in the trend analysis and try to use this technique. So you can be compared to a previous year, but also to what is known as the base year. Now, this base year, I'm emphasizing and repeating, while we are discussing together, is simply the first year in the normal set of operations. Whereas when you are really going to perform financial analysis for your own companies, probably in the future, you will be able to choose what is the base year for your companies, what is the normal year of operations, because we'll know the performance and the activity of that company, okay? So about the net income in 2020, when we compare with 2017, we have 496% over here. So I guess that there is a very obvious trend regarding the net income. We have an increase in the revenue, we have almost accompanying increase in the cost of sales. We don't know what's going on with gross profit, operating expenditure, EBIT, and so on, but we jump directly at the net income. And we are witnessing a very high increase in the net income, which is a very good thing for the company. So this means that the net income of the company is increasing more than the sales revenue. Ultimately, we can confirm that this company is able to keep its costs under control. So it's controlling its costs. They are not increasing at a higher rate than sales. Okay, so this is something that we can find out. You see, there is one last item which is not financial in its nature, but it's the units that are shipped or are delivered to the customers. How can we connect this piece of information to the financial items from financial statements? Let's see its trend and let's try to implement that piece of information somewhere there. So we start with 100% in 2017. Then when we compare the units delivered in 2018 with the units of 2017, we find out that they are 188%. Then we find another piece of information here. It is 307%, always compared to 2017. And then the percentage in 2020 is 448%. Now, the trend is increasing, that is obvious, but the rate of increasing units, what does that tell to you? I'm just leaving you 1 minute to think over that while I'm trying to put some notes on the comments. We explained and we talked a lot, but let me just put down something so we can have something written at the end. 1 minute so you can have an idea what the trend of units shipped means for this case. Something that we need to add about the unit sheet, some idea that you might have? Let's check. Okay, nothing in the chat as well. You remember that we discussed the number of the units shipped, remember, is nothing else than the volume of sales, you know? So how many units have I delivered, how many units have I shipped to the customers is simply the units that we have sold, or a very close approximation to that. So we mentioned that the volume of trade is a factor affecting both here, sales and cost of sales. Now you see that the volume of trade has been increasing, that is obvious, but if we refer to the last year, 2020, the units shipped are only 448% higher, not higher, but compared to 2017, whereas the sales are 469%. Can we say something about that? That means that the units shipped have increased, but at a lower rate. What does that imply for the price? What does it imply for the price? If you can finish the sentence.
So
I'm just writing down.
Prices increase more quickly than the units we sold.
This implies, if we can say that the price of selling is increased as well over the years. How can we arrive at this conclusion? Again, how can we arrive at this conclusion? Again, if we are increasing the sales revenue only due to the increase in the volume of trade, we would have the same percentage in the sales revenue item as in the number of units shipped, okay? But obviously we have a higher increase in sales. That means that part of the increase is due to the volume, but another part, which cannot be explained by the increase in the volume, is due to the increase in the price of selling the inventory. So again, the sales revenue is impacted by two factors over here. We are checking, we are controlling for the volume of trade, and we find out that it is increasing, that is obvious, but the rate of increase is lower than that of the sales revenue. That means that the price has been increasing as well over the years. Okay? Okay, thank you, Gloria, in the chat. Anything else we want to add about this case over here? So basically, we just introduced a more complete technique to use about the horizontal analysis whenever you have more data or more information. That also means that what you are finding in your annual reports that contains more than 2 years comparison of figures is most probably using this technique over here. So please be aware that you are always comparing to a kind of normal base year of operations. What the company has decided as a normal year, it depends on its judgment and the judgment of its managers, but still we have to know that the technique used relates to a base year, to a common year. Okay, if there is no question, we may continue. We have another problem, another case over here. Again, in the same tutorial, covering ratio analysis and techniques and also interpretation. There is the performance statements of Delta Company. There is a very, I would like to say, summarized income statement. We have only the basic lines. We start with net sales. The information is presented for 3 years, 2018, 19, and 2020. Then we have cost of sales, gross profit, selling expenditure, administrative, and then we have total operating expenses as the sum of selling and administrative over here. Then we have the operating income, which is basically EBIT, if this makes it clearer for you. From EBIT, we deduct the interest expenditure. We derive the earning before taxes over here. Then we deduct the income tax expense, if we can use the same abbreviations that we used even before. And then we receive, or we have the line of the net income. So in real world companies, you may have some more lines in between. Results from discontinued operations, finance costs related to subsidiaries, and so on. That is normal for consolidated big multinational companies. For a simple company, if we try to summarize and simplify the income statement, basically the most important items are always these over here. They are always in every example in every company. The other items may be existent in some, and you may not find them in some other cases, okay? What we are required to do is perform a vertical common size analysis. That is another technique that we use in analyzing information. That is that we have to compare every item in every year with the net sales amount of that year of the performance statements comment on significant trends. Okay, we have 3 years of information over here. We are not supposed to take 2018 as the base year and compare all the data to the base year. That is the horizontal analysis. It implies, the name implies to the way we calculate and compare items. Actually, this is vertical analysis. That means that I will focus in 1 year only. I will choose one item of the financial statement to be 100%. Usually that item is the total of the financial statement. In the income statement, that means that is the sales revenue. Be careful, the total is not always the bottom line of the statement. It's not the net income in this case. For the income statement, the total item that includes everything else is the sales revenue. We start from sales revenue and we deduct everything else. So we choose one item to represent 100%, and everything beyond that we compare to the sales revenue to see what is the amount of money they pretend to take from sales revenue. That is something that we need to pay to cover for this expenditure. This is the idea of vertical analysis. Other ways to explain that is that through the vertical analysis, I'm trying to reveal the internal structure of expenditures. How high is the percentage that they comply or they have out of the revenues of the company. Okay, having said that, explaining the technique, I'm just copying the table to make the calculations over here, and then we will add some comments on that. As we said, we will focus on each year one by one, and we'll make the comparisons within 1 year only. That means that I will start with 2018, and I will consider the sales revenue of 2018 as being 100%. I will compare the cost of sales to the net sales of the same year to calculate a percentage. And if you allow me, I already did that in Excel to facilitate and be a little fast here. We have 59.8%, sorry. I'm also writing the way that you perform calculations over here. So the structural percentage of each year will be equal to the sales of that year compared the amount of the item of the same year compared to the amount of the sales of that year. For example, that means that in 2018 I will compare cost of sales 2018 versus sales of 2018. And if we do that, of course, we always multiply by 100%. And if we do that, we'll have this percentage 59.8%. It's a basic calculation, I would say. Through Excel, it's very easy to perform formulas and then just copy the formula and there you go. But what we are revealing over here, you see, it's a simple calculation that reveals that, for example, in 2018, out of 100 euro or cent of sales revenue, I will need 59.8 euro or cents to cover for the cost of sales. That means that out of the sales, 59.8% will be directly expensed as a cost of sales expenditure. They will not represent a profit for the company. That means that what is left as gross profit is the difference between 100% and 59.8%. That is 40.2% over here. Another way to calculate this same percentage is by comparing the gross profit of 2018 always to the sales of 2018. I'm also gross profit of 2018. If we compare that to sales of 2018, again, will be 40.2%. We have the same percentages if we deduct 100% and 59.8%. If we make this calculation, basically it is the same. I guess that we all get that. So what we understand over here is that the gross margin, so that is what is left to the company to use for covering operating expenditure and for generating profit, is 40% in 2018. Is that good? Is that bad? We don't know yet. Why? Because we are not having a benchmark here to calculate or to compare. We are not comparing to another year, not yet, in 2018. We cannot compare to a competitor. We cannot compare to the average of the industry. So no benchmarking yet. We just calculate for 1 year, and we need to analyze by using a benchmark later. If we can continue with the calculations, the selling expenditure compared to the sales of 2018 will have 20%, and administrative expenditure represents 15% of the sales revenue. That means that the total operating expenditure, the sum of both selling and administrative, is 35% over here. That means that the EBIT, the difference between gross profit and operating expenditure, in this moment will be 5.2%. If we can comment on that, we would say that after selling, the company immediately uses 59.8% to cover the cost of sales, 20% to cover the selling expenditure, 15% to cover the general administrative expenditure, and then it is left with only 5.2% to cover interest, taxes, and to generate net income. Okay, so this is a kind of simple explanation we can have there. The interest expenditure, 100, when compared to the net sales, represent 0.4% over here. That means that the net income before taxes is 4.8%. If we calculate the percentage of the income taxes compared to the sales revenue, that is 2.1%, and that leaves us, or better say the company, with 2.7% net income. That means that this company, after selling and using everything to cover cost of sales in this amount over here, selling expenditure in this amount, administrative expenditure, and then this one for the interest and this one for the income taxes, it is left with 2.7 euro for each 100 euro sales. That is simplified interpretation. What can we understand out of this? Now imagine like you do not have these 2 other years. You just have one company for 1 year only, no benchmark against which to compare and have any idea. Can you understand anything out of this? Any idea how can we arrive at any simplified conclusion or something? It is hard, right? It's not easy to make a comparison. Something that we can do, not in this exercise, is to take competitors out of the same industry and see their structure of expenditure. Is it almost the same? Usually we expect companies operating in the same industry to have the same structural dispersion of expenditures. So usually the companies operating in retail, for example, they will have cost of sales more or less 60-65% of the sales revenue. If it is higher, something is not okay with that company. It will go very soon out of the market because it's not complying to the general dispersion of cost that is common and natural in that sector. So normally the structure of expenditure that we are revealing from this common size analysis helps us to understand if the company complies to what is normal for the sector it is operating in. But of course we have 2 other years against which to apply some comparison and to use as a benchmark. So we can start with 2019. Again, in 2019, we will consider the total revenues from sales. We will consider them to be 100%. So for each year, the 100% amount is the total revenue, because that is like the total thing that we have, and out of which we will take out first cost of sales, operating, interest, taxes, and what is left for us is the net income. So the total revenue is always 100%. And then we start by comparing cost of sales with sales, gross profit with sales, selling expenses with sales. That is why the name is vertical analysis. All the calculations are made toward the sales revenue. If we calculate the percentages starting from cost of sales over here, we have 62%. That means that the gross profit is 38%. We see immediately something we can comment, and we can see a trend, not very favorable for us. But let's start the calculations, and then we can comment something. we see that we have 24% the selling expenditure, sorry. The administrative expenditure are 13%. That means that the total operating expenses is 33.4%. The operating income EBIT is 4.6%. Then we have a very small percentage, as we expect that, 0.3% at the interest expenditure, 4.3% the earnings before taxes. Income tax is 2% in this year, and then we have the net income equal to 2.3%. Now, I guess that there are some trends very obvious to comment from 2018 to 2019, but I would prefer to calculate everything and then let's make some analysis over there. What about the 2020, which is the current year? Again, in this year, we consider the total sales revenue 100%, and we want to reveal the structure of the expenditure for our year, for current year. So we continue to compare the expenses for 2020 with the sales revenue for the same year. So again, the modality of calculation is following the vertical analysis. We find out that the cost of sales represents 65% of the revenues. Now that is something that we can say something about. The gross profit, therefore, is only 35%. The selling expenditure is 19.9%. The administrative expenses is 11.1%. Total operating expenditure, therefore, is 31%. The operating profit, the EBIT, is 4%. The interest expenditure is 0.3% over here. The net income before taxes is 3.7%, and the income tax expenditure is 1.7%. That leaves us with a net income that represents only 2% of the net sales over here. Okay, so this is the calculation, the easiest part. Now we have to say something. I'm not requiring you to make a full essay or something, just 2 or 3 points that we may want to emphasize about the performance of this company. I think the situation is pretty clear, okay? We are not able, using this technique, we are not able to say something about the net sales have been increasing or not. Obviously, they are increased, but as we are not applying the horizontal analysis, you cannot say that. So just focus on the structure of the expenditure, and by comparing the percentages with one another, you have performed the structural vertical analysis, but you also can compare from one year to the other, if that is clear. So what we can say about anything over there?
We can say that cost of sales is growing more than the other costs.
Mm-hmm.
So the gross profit that cover other expenses is every year less.
So the first thing is that the cost of goods sold is increasing, and pretending, I'm using this word, it's not the right one, but again, is pretending more money out of the sales. That is that each year we spend more and more money out of the sales revenue to cover only the cost of sales. In other words, each year it costs me more to provide the inventory that I'm selling. In each year I'm buying the inventory that I'm reselling at higher prices, if that makes sense. So the profitability measured or represented only by the gross profit over here is declining. That means that the company is being squeezed down regarding its gross margin. If we are operating in a very competitive sector or industry, probably that may be normal. We have more competitors coming in and our margins are getting tighter. Maybe that is the case. So we are witnessing that over there. This is something, the gross margin. Are going down. Something else though that I put in green color, that means something good, not bad. You can see that the total operating expenditure are being controlled very well by the company. That means that while we are increasing the cost of sales, something that probably is inevitable for us, probably the sector is experiencing high prices, we have higher competition, so something is beyond our control. As a company, at least we've done something good. We are keeping down, we are controlling our operating expenditure. You see that from one year to the other, we are reducing selling expenses and we are reducing administrative expenses as well. Control, good control of other operating expenses. And that is something good for the company because only due to that you can see that the net income is decreasing, of course, we cannot deny that. But imagine if the operating expenses have the same increase as the cost of sales, we would not be operating at net income at all. So it's only due to the control of the operating expenditure that the company has not had a higher decrease or an even further decrease in the net income. Having said that, I have to remind you of something. Consider the structure of the expenditure over here. Yes, we have been doing very good in trying to control them, but remember that they are not the biggest part of our expenditure. They represent in total almost 1/3 of the expenditure, 30 and some percent. So we can be very good at controlling this expenditure, but they are the minor part in our expenditure structure. Our efforts should be directed towards controlling the cost of sales for every company that represents the highest item of expenditure. And the companies should control very well the contracts with suppliers to check for the purchase prices, the transportation costs, the cost of labor, because the direct labor is often included there, and also to check for the depreciation, amortization, and other items that are usually included in the cost of sales. I don't know if that is clear and makes sense, how to interpret the data. Any question you might have? Okay, thank you, Gloria, as well. Any question for you? We will have a 5-minute break and then we continue. Okay, we have a problem with the system. So,
老师看到那个问题，让他没想通。
Give me a break.
他着急，怎么
去上厕所。
Io spero che mi erano un dato di dati che mi hanno non ha senso anche perché allora Italia sbagliata abbiamo tutti gli stessi numeri che sono coerenti
Esatto, perché
se tutti usiamo gli stessi dati non puoi dire che lei non può dirci è sbagliato. Ma se invece uno usa magari, ne so, nel senso usa 1 milione e l'altro usa 2 milioni,
esatto, ovviamente è diverso.
ovviamente devo vedere questo diverso.
qua perché ora sto calcolando i dati che ho messo a parte qualche segno mi sembra tutto corretto.
Non segna poi importante.
Cioè,
Non hai
sì,
Ah, perché sta facendo l'altro corso. Sei la seconda anno.
sì, ho capito, ma ora avevamo degli esercizi che riguardano la parte. Cioè, scusami, è meglio di tu. Cioè, poi ha anche preso la cosa più semplice perché era proprio semplice.
Dei calcoli che poi fare è increase.
Cioè, io capisco
Devi solo dire
Perché? Esatto.
capisco che sia
come
il
te lo
secondo
faccio
anno
adesso.
e che devi stare attento alle cose esercizi e che oggi dobbiamo caricare la presentazione perché non si può dirli?
Ma anche gli anni da stare a fare.
Sì, anche io. Anche
Ah, tra l'altro ci devo ancora caricarlo, non sono qua.
Della descrizione
Ah, vabbè.
magari
vabbè, teoriche, invece ovviamente si chiama adesso vorranno
No, io non
Vuole tanto.
le cose gli aggiusti.
lo so, ma poi quando tu mi hai chiesto ma dove prendi questi numeri? E poi ho scritto su lì, ho scritto su quello lì che ti ho mandato il link.
Ah, sì,
Ho scritto ho scritto numerazioni 2020-2019.
no, ma perché pensavo dover solo le note e però le note
Non c'era scritto.
c'era di scienze
È particolare
poi stavo andando a vedere su PSA e non c'era scritto ma perché qua c'è scritto
e vabbè non ci scrivo, io mi scrivo. Mi manda un altro. Sai io? Ho problemi, ho un problema.
Non riesco.
Non riesco a trovare il marketplace. E io adesso ho cercato le variazioni, quindi dico vabbè, magari si trovano le variazioni di ascoltare anche il marketplace. Quindi ho scritto here G.
Niente.
Number of shares. E mi arriva questa pagina con questa tabella.
C'è tutto.
tutti i dati che mi servivano per calcolare l'investment.
E io sono impazzita. E tu
Stai cercando pure solo da fare.
sì.
你那个文件弄得真好，标的很清晰。我觉得你以后估计就会做财务吧，财务人的潜质就是都弄得很清晰。
我感觉就是感觉给自己方便一点。
这是一个很好的习惯，坚持下去比较难。
Dai, è una cosa.
15. Again, this is the same thing as expressing that in percentage, 0.15%. In order to not be confused with two values, I'm just keeping the 15% and not making more confusion out of that. The x2 component of the formula is the ratio between the retained earnings to the total retained earnings to the total assets. Again, this second component in the original z-score formula should be represented in percentage. Again, why? This was the format back then. So when the software came up with this equation, what the software recognized with X2, retained earnings to total assets, was a percentage, okay? Not a value in times, but percentage. So again, if we calculate and compare retained earnings from the, of course, from the balance sheet, okay, to the total assets, 400,000, multiplied by 100%, 100, sorry, not percent, that is my mistake. Please remind me if I do some mistake on the way. We can find a percentage of 5% over here, okay? The third ratio included in the model is the ratio between earning before interest and taxes compared again to total assets. You see that these structural ratios, I'm calling these ratios structural because they compare different items to total assets. You see that total assets are important to distinguish and make the discrimination, the distinction between successful and non-successful companies. Okay? So again, if we calculate the ratio, it is 40,000 compared to 400,000 multiplied by 100, and we have a percentage of 10% over here for X3. The fourth component, again, should be expressed in percentage. Don't forget the general rule. The fourth ratio compares market value of equity to the book value of debts. Now this is, sorry about that. This is actually a novelty in using financial ratios, because this is the only ratio that combines data from market and data from the accounting books. The market value of equity will usually be calculated by combining the number of shares outstanding with the price of the shares, whereas the book value of debt is generally an accounting item, an accounting value. Also, this ratio will be expressed in percentage. Over here, if we make the calculation, that would be like 40%, if we compare the two items together. And then we come at X5, the last one, that is the sales to the total assets. Sales to total assets is also known as the assets turnover ratio, we know that, and this is the only ratio that should be expressed in times, okay? So whenever we make the calculations over here, we say 300,000 compared to 400,000, that is equal with 0.75 times. Let me further complete the previous calculation. I skipped that. That is 80,000 compared to 200, equal to 40%. So we have the final value included over here, and we can substitute in the equation very easily, and then what we find, allow me to take a shortcut, not to make the substitution and then show the result, but just directly jump at the result. If we combine all the ratios together with the appropriate coefficient, I'm aware that this is easier done with an Excel file, and I previously did that. We get a result of 1.57, 1.57, not a percentage, not a time, this is a score. Just 1.57, not euro, not dollar, not percentage, not time, just a value, okay? Now, what is the interpretation for that? Now, remember that the general values is that lower than 1.81 is implying the general rules that we usually follow are this one here, lower or higher than general values from 181 to 299, between 181 and 299, there is the so-called the gray area. We don't know what is going on. And this is like the original model that was introduced. Now, considering the values, we can see that our company is considered a somewhat risky company. Of course, we have to keep in mind the limitations of the model. Okay, but if we stick only to these results and we compare the z-score that we get out of applying the formula and the model, if we compare to the values over here, we can see that we are in the probably bankrupt companies interval or range for our company, okay? Anything to ask about what we have covered so far? This is something that we explained even before. Now, I want to extend that further to clarify your doubts and your questions. Now, after presenting and introducing the original model, that was leaving a very wide range of gray area, the model was criticized for not being clear enough because, as you can see, from 181 to 299, value of the z-score is a very wide range that we don't know actually how the companies will behave in the future. So as the model was criticized, yes, it is market value of equity is the same as market capitalization, is the same thing. So what I was saying is that the first model was criticized for having a very wide range of gray area, not being decisive about the future of a company. And later, a further version of the z-score model determined what is known as a cut-off point. The cut-off point was decided to be 2.6075. That means that for the companies below 2.675, they were considered bankrupt, and above this value, they were considered non-bankrupt. Now, who decided the cut-off point? Of course, the software did. The technique used by the professor was multiple discriminant analysis. It's not logistic regression, does not represent probabilities of what is the probability of going bankrupt in 2021 or 2022. It doesn't do that. It is a very special technique that discriminates between companies and says whether you will go bankrupt or not with 100%, but not with probabilities. So it's different from logistic regression. It's a different technique. And feeding the data again to the software decided that the cutoff point for those people that were not happy to have a very wide range of gray area, the cutoff point is 2.675. Below the cutoff point, the companies are more likely to go bankrupt in the future. Above that value, okay. So this is like the new rules to apply, and maybe you can use that. It's okay if you use that cutoff point. It's very practical. Something else that I wanted to add. Many of you have had questions that what you look online as the z-score formula is not this one. Okay, so I'm just copying and pasting. This is the original. I'm emphasizing that. Original model. Now, the more useful and practical version. What is the more useful and practical version that we usually find in the internet? It's basically the same. What they do is that they represent x1 not in percentage, but in times. And that means that we have to move the decimal with 2 places, from 0.012 to 1.2. So this makes the coefficient 1.2, and the working capital to total assets should be expressed in times. That means the value over here should be 0.15 times. This is the difference that the two models have. Only for the first one I'm continuing. But if you get, it's not a different model, it's just an adjusted version to become more useful and easier to use. But please remember that the easier version requires all the coefficients adjusted, of course, but all the ratios expressed in times. We continue with the x2. Again, we express the x2 in times, okay? And that means that we'll have here not 5%, but how much will that be? 0.15 0 5 times, and that means that I will also move the decimal point over here. Here it will be 1.4x2. So simply simplifying and adjusting the expression. Is that clear for everybody? So I'm just continuing. It's the same thing with x3. We move the decimal point to avoid large number that make us confused, but then we have to adjust the expression of the ratio as well. So when we come at x3, we say that that is expressed in times. We remove the percentage, and then that means 10% is equal with 0.1 times as well. The same thing is done for x4. We move the decimal with 2 places. That means that we have to change the expression of x4 from percentage to times. And that means that we'll have here 0.4 times the expression of x4. Is that clear till now? For the last coefficient, nothing to do because that is already expressed in times. Something that we can easily understand is that 0.999 is simply 1. If we approximate that to the general simple value. So what you actually get as a z-score in internet is basically the same original model. Is not one of the future models that Professor Altman developed in Hong Kong or Tokyo and so on with their data from their stock exchanges. Is basically the original model but adjusted to be more easily performed and put in practice and calculated. Is that clear for everybody? If you calculate that, you'll have the same result. But just be careful when you apply the model to take the right version and expression of every ratio. Oh, I've had this question from many of you, and I also had this question in the chat this morning. I hope that had an answer. If anybody that is hearing from home has anything to ask further, please feel free to ask in the chat before we continue. Any other questions from you as well? That is okay, right? Again, I'm not requiring from you to memorize the z-score formula. I just wanted you to understand the difference between the original full model and the one that you find online is the same. And I want you to exercise caution when you calculate the z-score. Using Excel, of course, but remember the way that you are expressing the ratios. Are they percentages or are they in times? Sometimes we don't pay attention to that and we may arrive at the wrong conclusion, at the wrong result. The same way when we prepare the cash flow statement, sometimes we don't pay attention whether it is a minus or a plus, but that takes us to the wrong result. The same is here. So in other instances, it doesn't matter if you express a ratio in percentage or in times, but in this score, in the z-score, it is important to pay attention how you are calculating the ratio, in percentages or in time. Questions? I hope that was covering for everything that we were striving to understand. Now remember that yesterday we couldn't actually finish the representation of the non-financial indicators, so please allow me to continue today and to finish what we started yesterday. I hope that you are all seeing the screen. Okay. I hope that the screen is also visible for all of you. Of course, we are not going to take a long time to recap everything that we explained yesterday. We talked about the key performance indicator and the alternative or additional performance measures. We covered the environmental reporting, social reporting, sustainability reporting. Today we are going to talk very briefly about integrated reporting and illustrate that through a real-world company. I'm going to talk briefly because right after this we have tutorial 6 to go through, and with that we are going to look at simplified examples on how the KPIs and APMs really work in practice and how we can use them, okay? So what I also wanted to add is that probably in the further courses that you are taking in MBA degree, you are going to learn more about environmental reporting or integrated reporting. Maybe you will have some elective courses next year where you will learn more about sustainability reporting. So this is not the primary thing that we need to know in our course. Our course is IGAP and financial statement analysis, but as you find this information in the annual report, as I said, even before the financial information, I should be able how to read that information and how that impacts the way I'm understanding and analyzing the financial ratios. Okay, this is the only reason why we are going through this part over here. So we explained everything, the KPIs and the APMs and the various APM indicators introduced by companies, and various attempts to try to regulate how the APMs are calculated, presented, disclosed, and interpreted in the financial statements. We mentioned the European Stock Market Authority that was trying to regulate this area, but still there is much to be done according to the APMs. ESMA guidelines for those who want to read more, comparatives, consistency, and so on, the benefits, the drawbacks of APMs, and then the limitation of financial information. Of course, we like to emphasize that financial information is important, is regulated, there are standards that govern the representation of financial information. That means that it is reliable. Okay, it is reliable, but it has many limitations. It's historical, it's outdated, it doesn't give a clue about what's going on to happen in the future for the company. So given all these constraints and limitations, how can I use some other possibly non-financial information to have a prospective idea about the future of the company? This is why we are including the non-financial information over here. So again, non-financial performance measures start with basically environmental indicators, then they extend to include the social reporting, corporate social reporting, which basically is environmental, but also the social contribution of the corporation into the community and the society. And then from the corporate social reporting, we jump to the sustainability reporting, that is environmental, social, but also keeping in mind the probable sustainability or living resources for future generations as well. There is an attempt from the European Commission to make it required not only for larger public companies, but also for all the big companies to comply with the sustainability reporting. So very soon you will find not only the companies listed in the stock market, but also the big companies, private, not listed, they will have to comply with sustainability reporting. That is why it is being emphasized and introduced and also included as an elective course in your curricula later. Of course, there is many attempts worldwide. That's why the EU really jumped in there and it's trying to regulate for its own companies. There are some updates about the latest movements in sustainability reporting in April of this year. It was introduced the idea to have it mandatory for all the big companies, as I mentioned. There are some lines, some links there that you can follow and have more information when you have time, of course, because right now it is the group presentation and the exam that you have to prepare, but if you want and are curious to know more about, why not spending time and read about that? Something that we need to keep in mind is that if it becomes mandatory, it will become also audited. That will further increase the costs for the company. So we will have, as companies, we'll have more costs to prepare the information, and we need more costs to pay the auditors to audit this information. Okay, so that means to double the cost for the companies. And then further from sustainability reporting, recently in the last decade, we have what is known as integrated reporting. The integrated reporting is the general approach of having in one simple report, in one simple document, all the elements, the financial reporting, environmental, social, sustainability. So the integrated reporting tries to connect together financial and non-financial information into a general report. But of course, integrated reporting is an approach that is not regulated yet. So it's not under some standards like IFRS for the financial information. The non-financial information is still not regulated, not audited, and therefore when included in analysis, it should be considered with very high level of caution and attention from you, okay? The impact of the integrated reporting, of course, is big for companies, and the European Union, I have to mention, is very much in advance regarding the integrated reporting. You will find many big companies that use this approach, trying to be in advance of the regulations that are coming to force very soon. Something that I need to add, you will find there various attempts to regulate this area, for example, the Integrated Council, and that is explained over there. I don't want you to memorize this. You will not be required to know this information. It's just an extra or optional information you may have. What I want you to understand is that in an integrated report, we usually try to link financial and non-financial indicators by understanding what is the impact of every step of the strategy of the company on its resources and revenue and expenditure. I guess I explained this yesterday, but I'm bringing that as an example today. For example, many companies, they will report on the level of the CO2, the carbon emission. Okay, they report on the level of the carbon emission, and they say that they are having a target and they are moving slowly or fast towards this target, and they express the emission of the carbon or gas emission in some amount of physical measuring. To the financial point of view, that doesn't make any sense. When I read that information, I want to know about revenue and expenditure and income and assets. This gas emission data that you are reporting there doesn't make a sense to me. It doesn't ring a bell anywhere. What would be really important for me to read, it would be some information that was stating, for example, trying to reach the target for the low carbon emission, we are spending this much money this year and this much money that year. So this makes sense. What is the expenditure that you are paying or you are incurring towards achieving some target regarding environmental impact or social impact? This is what the integrated reporting is trying to do. Not only reporting the targets regarding the sustainable development goals of the UN, but actually what is the cost that you are paying to achieve those targets. Of course, I'm saying that the integrated reporting is not regulated yet. There are many companies trying to report this kind of information, but it's not easy for the companies and it's not always convenient for them. As you may have noticed, many companies do not really enjoy disclosing information. They are not enjoying giving the confidential information for you. They are just trying to keep it for themselves. So trying to push companies to disclose how much money they are paying to keep up with the targeted carbon emission is not something that they will voluntarily choose and jump and do that. They will eventually have to do that to comply with the regulations, but this is not something that you will find easily readable and available, usually in your own cases. So again, you have to read for yourself, being that an optional and extra information. I'm not taking your time to take you through that, if you allow. Just read about the attempts of the integrated reporting framework. Basically, we find three components there: the capitals the company is using, the organization's business model, the creation of value over time. Let me take you once again at the case of Carrefour. You remember Carrefour that we shared yesterday? The beautiful diagram that they show how they interrelate the farms, the supply chains, the customer, and so on. You see the components included and explained there. So integrated report should include the capitals. You see here the capital and resources. Oh, it's better now, no more sun. Capital and resources over here, and you have the creation of the value on the other side of the slide, and the business model of different components, how they interrelate together. You see the central part of the slide over here. So basically this beautiful diagram, it's nothing else than a representation of the components required from the integrated reporting. What capitals are you using, how you create value, and what is your business model? Basically 3 components. Now you see that the capital, it's not only financial and economic, like a number of stores or the amount of the equity and financing and so on, but it is also has a very great emphasis on human capital, which you know is not measured in the financial statements. Whatever good employees or not very good employees you have, or how much money you spend on training them is not recognized as an asset in the financial statements. That is not fair, actually. And also the relational capital. What are your relations with suppliers and customers? And your position in the distribution channels usually is a very important factor for success for companies, but it's not easily readable from the financial statements. So these are important information. Remember, are not regulated, are not audited, but still they are important to be kept into account and to be taken into consideration when you interpret the data. Okay, long story short, the content of the integrated reporting should be like this, and then I would like to just show for not more than 5 minutes the integrated report of 2019. I couldn't actually, I didn't have time to take. Okay. What you see here is SAP. SAP is a company that operates is the biggest software vendor in the world. They offer software solutions for companies, usually enterprise resource planning system. And they are the biggest company in the world. It's a German-based company. Now their integrated report, before they even start with their contents of the report, you see that they are reporting some, maybe you don't see at all because it's small numbers. Okay, is it better now? Okay, we cannot open more because it's not. Okay, now I think that it's visible at least. You can see that the company, the integrated report, is disclosing at the very first pages some indicators that are key performance indicators for that company. Financial key performance indicators. In here you see net liquidity, net debt, day sales outstanding or debtor days as we know them, equity ratio, effective tax rate, and effective tax rate non-IFRS. That means that this company, as the headquarters are in Germany, they apply the German tax code to calculate the tax amount. So they disclose the effective tax rate by applying IFRS, but by also applying non-IFRS rules, that is the German tax code over here, okay? So every time the data is not abiding to the IFRS, it is disclosed by the company in brackets over there. Only the first panel has financial key performance indicators. The other information over here, it is basically non-financial. You see some information about the order entry. Basically, the company is disclosing the revenue that it is having from cloud booking. The biggest amount of the revenue from this company, the largest source of revenue, is offering cloud services. The enterprise resource planning system are operating in cloud right now, and the company facilitates the cloud services. It is a service provider for cloud services for companies. And these are the new cloud bookings. That means new customers approaching the company. And you see that you have an increase like 25% from 2018 to 2019. Then they disclose the contract liabilities or the deferred income according to IFRS, order, number of on-premise software deals, share of software orders, and so on. Then they share some information about their stock, the earnings per share, and also the earnings per share if we do not apply IFRS but the German legislation, as this company is German, headquarters in Germany, as we said. Then dividend and market capitalization or market value. Then you see other important indicators regarding employees, customers, or environment. Again, this is not regulated information, but this company chooses to disclose what it considers important for future investor and analysts to try to interpret and have a final decision on the performance of the company. For example, you can see that the number of employees has increased, but also the personal expenses per employee, the average expenditure that you are paying your employees, it has been increasing from one year to the other. The percentage of women, the gender balance dimension that should be included always according to the CDGs of the UN, they disclose that they have a higher percentage now of women working at the company. And so on, women in management, that is also a very interesting indicator to show gender balance in decision making at higher ranking of top management. You can see that the company is disclosing these facts. Again, it's not financial. And we don't know actually very well how that trend will go on in the future. But you are likely to find similar information for your companies. Probably you have already completed that part for your projects. And be prepared to say something about that. Okay, this is something that I explained a little bit earlier. You see they report in the environmental matrix over there. They report the net greenhouse gas emission in kilotons, but they do not disclose how much did lowering. You see that we have a decrease in the gas emission from 310 to 300. It does not give any information how much did that cost for the company. What percentage of the increase in the expenditure is due to the attempts to keep down the gas emissions, if you know what I mean. So this kind of non-financial information sometimes is not related to financial data, making it more difficult for us to understand this kind of information, okay? Of course, the report continues with many other data, but as I said, I just wanted to give you an idea how integrated reporting looks like, and not having too much time on that. Right now, I'd like to jump on the tutorial. We have tutorial 6 posted on Moodle. Maybe we can have a 5-minute break until I prepare the screen. And then after the short break we are having, we'll discuss. They are not exercises, actually. They are more like cases, mini cases to discuss together, related with industry analysis, accounting analysis, and the APMs that we just covered. So after the break, we are going to discuss about tutorial 6.
怎么参与一个练习啊？
所以你觉得明天只有他自己吗？你觉得明天只有他自己吗？
没有，绝对有不死跟老贝。
真的吗？可是他们怎么看见里面的还没有结束小组啊？
可能 approximately my guess
我都不想听了这个。
我觉得这样好累啊。
都是理论，有什么评价？
So I really want us to discuss together when we are going through these short cases. I would not call them problems or exercises because most of them do not imply calculating anything, but just interpreting and trying to understand. So this is related to the interpretation of financial statements. So it is related mainly with the industry analysis or accounting analysis, incentives or tools and techniques to manipulate the information or to manage the earnings, and how we can learn from these examples. So I don't know if you have had any time. I guess, not to look through this information. So we better read them very slowly and try to understand and benefit from them. So we have the case of one company. They have issued some class B shares. That means that they are shares but have not full features or characteristics of the common shares. Probably they are not representing the rights of ownership, full ownership for their holders. It has recorded them as equity instruments in the statement of financial position, but under the terms of the shareholder agreement, we can see that these Class B shares should be redeemed in 3 years' time. That means that if we carefully assess the features and characteristics of these shares, they may be called or they may have the name shares, but actually they are bonds or they are debentures. They are debt instruments. Okay, so they are not equity, as the company has wrongly included them in the statement of financial position. Now, this is obviously an error, and the impact of this error in the financial statement, we have to discuss the impact of the error, and then we have to imply what does that mean for the actual specific financial ratios that we may think are impacted of this error over there. So what we can write here as an answer for this case is that what we do to correct the above error, we should reclassify the Class B shares to debt instrument. Okay? So this is the first thing that we need to do in order to correct the error previously made in the classification of this equity. It is wrong. Actually, it has features of loan or debt because it should be redeemed in 3 years' time. It is not equity after all. Equity should be forever. It doesn't have a maturity time or a maturity period. So this is obviously not shares, but it is debt instrument. Okay. The above error affects at least these ratios. Can you think of any? Wrongly classifying some debt as equity, or probably that is not done wrongly but on purpose. We don't know the motives, but this is an error, obviously. Now, by doing that, I am classifying some debt instrument as equity, but actually they are debt. What does that affect regarding the financial ratios as we know them? The very first thing that I have in my mind, and the easiest one, is the total debt ratio, right? Total debt ratio. That is the ratio between total liabilities to total liabilities plus equity, but that means that that is the total assets. So what is the impact on the total debt ratio of this error that we are doing or correcting the error?
Increased.
Okay. Wrongly classifying the debt instrument as equity, we are actually understating the total debt ratio. We are declaring total debt ratio lower than it really is. So probably this is not an error, but a movement on purpose on behalf of the company, who knows. But we can see that from wrongly classifying some shares, some debt as shares, we are understating, that is, we are reporting a lower value for the total debt ratio. Is that understandable for everybody? Should I explain it further, or that is okay? So the first thing that I have in my mind is the total debt ratio is affected by every misclassification or wrong classification of equity or debt or vice versa between each other. Now, having said that, let me remind you of something. Whenever I think we didn't have any chance to discuss that before together. Sometimes when you read, because I see that you like to refer to internet sources, and it's good for you to read as much as you can, but in several occasions you may find that sometimes in the total debt ratio, do not write this down, just keep in mind that sometimes you may have this situation, don't be surprised by that. To the total liabilities, they usually add also the preferred shares. So if you may see, please don't write that down, I will delete everything later. But the total debt ratio compares total liabilities plus preferred shares. So usually when I want to try to understand the total burden of liability and debts and loans for the company, it's better for me to keep in mind that except for the normal liabilities, which is total liabilities, also the preferred shares usually have maturity dates. Preferred shares are a very specific class of shares or stock that will be repaid or converted at a later date. So they have a maturity date after 5 years or 10 years that makes them have features and characteristics of the bonds or the debts or the loans. So don't be surprised if you calculate the total debt ratio and you find that the preferred shares are considered as debt instruments. That is common, that is normal. Why? Because the preferred shares, they are disclosed and reported under international financial reporting standards. They are included in the equity section, okay, but for the analysis point of view, I have to be fair and honest and say, okay, this is not equity, this is debt. It will be repaid after 5 years. So this is liability. It may have the name shares, but it is not shares actually. The same thing is Class B shares over there. It has been reported as equity, but if you look very carefully beyond the words, you know that in financial reporting we have that principle of substance over form, right? So we have to go beyond the form, we have to go into the substance of the transaction. And if you go into the substance of shares B, Class B there, you see that they are not shares at all. They may have whatever name they want to have, but they are debt instruments. So if you reclassify them in the debt section, that would actually increase your total debt ratio. Meaning right now, the debt ratio is understated, is reported or calculated lower than it really is. That makes the company attractive to foreign investor and so on. And maybe that is the incentive why the company in the first place declares and classifies these Class B shares as shares instead of debt instrument as they really are. Is that clear? So keep in mind that sometimes even the preferred shares, to be really accurate, really honest and fair with the calculation and interpretation, actually they are also liabilities. We are not going into that right now, but just for you to not be surprised if you find something like this in the literature that you read from other authors maybe. Another ratio that would be impacted, can you think of something? Debt to equity ratio and ROA. We have, okay, I'm taking that, debt to equity ratio is also understated, right? Because we are reporting less debt, more equity, and this ratio will be also understated. Your friend is proposing ROA as well. What about ROA? What is the implication in the return on equity? ROA is understated or overstated? What do you think? Let's see if we have any answer. Alessandro is suggesting debt to equity, we said that, and ROA. What do you think about ROA? Return on equity, if we classify these shares, okay, actually we classify this as shares but they are debt actually, we report a higher value of equity and a lower value of ROA. So the profitability is also understated. So, of course, we want a lower value of the total debt, but also the ROI, you can see that it is affected by the misclassification of this instrument. Instead of that, it is included as equity. Any other ratio that might be affected? What do you think? I might think of something else. Is the interest coverage going to be affected by this? What do you think? Interest coverage? Any idea? So we have EBIT compared to interest expenditure. Now remember that earning before taxes and interest is above the interest. So however you classify this instrument, either as debt or as shares, EBIT is not going to change, okay? Because it is above the interest. Whatever you do after that, below EBIT, interest or dividend, the EBIT is not going to be affected, okay? But the amount of the interest, it is going to be lower if you consider this to be a share. But if you consider this to be debt and you consider the dividend paid on these shares as they really are, as interest expenditures should be higher and the interest coverage lower. So basically what you are doing right now is that you are overstating the interest coverage. How? By reporting lower interest expenses through considering the payments for these Class B shares as dividends, not as interest expenses. Is that clear? Okay, that is not easy. I understand that. It is a little bit advanced to think about the correction of errors and the implication on different ratios. Personally, I think this is like the maximum benefit you can get from financial analysis. Is not calculating ratios and interpreting them. That's one thing. But I personally think that the best student from you should be able not simply to calculate and interpret ratios, that's good, but if you are able to think of possible transactions, errors or correction of errors, how they impact financial statements and financial ratios, that is like the maximum ability you can get out of this course. I don't know if that's clear. So it's not basically linked to the ability to calculate ratios. Softwares can do that. They probably can also suggest some, especially the expert systems, they can suggest some ideas to comment, but if you are able to get how a transaction will impact the financial statements, that is the maximum objective, learning objective of our course. Should I explain further the interest coverage ratio? So it is comparing EBIT and interest expenses, as we said. Misclassifying this instrument does not affect EBIT. Why? Because earning before interest and taxes is what the name implies, is earning before interest and before dividend as well. Whatever you do with both items will not affect EBIT, but it will affect interest expenses. If you are misclassifying, you are understating the interest expenses. They should be higher. Understating the denominator of a ratio means overstating the ratio itself. Okay? And you need to further elaborate on any of that? Okay. If not, I would like to continue with the second exercise. We have several examples again, and we have to exercise our judgment on the impact on, I guess, earning per share in this case. We have a public limited company over here preparing consolidated financial statements for the year ended 2021. The company has ownership of 75% of the equity shares of Foxtrot for a number of years. That means that it has full control over this other company. They are preparing fully consolidated accounts. The following accounting issues have yet to be finalized. We have to decide what to do about these cases over here. And we have 3 examples. What we are required to do is to explain with calculations how the above events should be corrected in the consolidated financial statements and to discuss the impact of these corrections on basic and diluted earnings per share without calculations for all this. Okay, so let's start with the first one. On 1st of January, we have 1,000 managers that were granted 500 share options each. They will vest on 31st of December 2023 if the managers are still employed by Clues, by the company. You remember the compensation packages that we mentioned? The compensation packages for the managers include shares options. And share options are vested or exercisable, executed if the managers will still be part of the company 3 years later, 3 years from now. The fair value of one share option is €6. By 31st of December, 50 of these managers have left the business and other 80 are expected to leave by the vesting date. The exercise price of the option is €3. The average price of one equity share is 10 and no entries have been posted in relation to this share option scheme. Now, even though it requires us to make any calculations needed, I assume that you have done this in the first part of our course. You have been preparing and learning about consolidated financial statement. So together we are not going into calculating how to consolidate accounts. We are leaving that to the first part. I assume that you are all very good at that and you all deserve an A+. I'm just concerned about how this will affect two ratios, that is basic earnings per share and diluted earnings per share as well. So to have an answer about what this transaction will bring for these 2 indicators. Now remember that the basic earnings per share is equal to the net income available to the common shareholders divided by the weighted average, but I'm just skipping that name, divided to the number of shares. But remember that it is weighted average number of shares outstanding, okay? So here we have the formula of the basic earning per share, net income compared to the number of shares. Does this transaction, which has very many details in there, I understand that, but does any of that affect either net income or the number of shares? We have issued some options for our managers, and some of them have already exercised the options. Does that change anything in what we have to disclose in there? What do you think? Any idea what to disclose in financial statements? Exercising the options for the managers does not need any kind of adjustment in the basic earning per share because this is the basic indicator, so no change or no impact in this first indicator. But if you take into account the diluted earning per share, and that will mean adjusted net income, where adjusted means that I have to take into account net income adjusted with a post-tax effect of the conversion of options to shares, if any. If no adjustment, that means no adjustment. We know that in the case of the share options, the net income will not change. So rest assured that the adjusted net income is the same as the net income, but I have to compare that with the adjusted number of shares. Now, that is something that we know that has changed. In the event of exercising the options, we have more shares outstanding. That means that we will have a higher denominator of this ratio, or in simpler words, we will have the same amount of earnings divided by more shareholders, because right now some of our managers are converted into shareholders as well. So the same amount of earnings divided by more shareholders, that means a lower diluted earnings per share. So decrease of this, that means decrease of this ratio over here. This is what I want you to think about the transactions. Not the first requirement relates to what you have done in the first part of the course. If we would have more time right now, we'd go into details about that, saying what account will be debited and credited and so on. But assuming you know that, we are just going and jumping to the effects of each event and transaction on the two financial ratios, basic and diluted earnings per share. Does that make any sense for you? Should I further elaborate, or can we go to the second example, second case? Okay, we have here this example about the treatment of a piece of land. We have freehold land that is accounted for using revaluation model. You are aware that we have the revaluation model available to apply according to IAS 16. And according to this model, the revaluation has taken place in the current year. But however, one piece of land, one particular asset, let's say, is still carried at its purchase cost. That means that I have applied IAS 16, I have to be consistent, and if I apply the revaluation model for all the other plots of land, I have to apply the revaluation model even for this forgotten plot of land somewhere, so I have to revalue that. The carrying cost, the purchase cost, is the carrying value for 1 million, whereas similar plots of land have been sold for 5 million. That means that the fair value of this piece of land is 5 million. The historical cost that I have in my accounting books is 4, but this is a mistake, but because following IAS 16 I should have the same treatment of similar items of assets, so I have to revalue this piece of land. What will that cause, if anything, to the two ratios we are talking about? Remember, basic earnings per share and diluted earnings per share. Revaluating upwards the assets, what will cause for the company? Any change to the items that I'm interested in? Net income? Any change to the number of shares? I'm waiting some ideas. Revaluating upwards the asset. What will that bring for the company? Will it increase the net income? Excuse me, is this exercise too difficult for you? No, that is not, sorry. I'm just asking, is this exercise too difficult for you, that you are not answering, or you are tired, or the last option is this exercise is too simple and you are sleeping? So should I understand that this exercise is too difficult? Can you please give me a feedback?
It's not difficult, just you don't have the idea because it's new concept probably for me.
Okay. So again, this is, we have to revalue the assets outside of this specific example. We have to think about what is the transaction that is happening and what the transaction has an impact or effect in the financial statements. I'm not requiring the full impact on every item of 4 financial statements, only on 2 of them, net income, number of shares. So this thing that is happening over there, does it change anything in the net income? Does it change anything in the number of shares or not? One of your friends has tried to put an answer in the chat. Thank you, Emanuela. Emanuela is suggesting that we have an increase in the net income. Think well. When you have discussed with Professor Busso about the revaluation reserve and the gain from revaluation, where are they included? In the income statement or in the comprehensive other items? Okay? Have you discussed this, or I'm talking foreign language here? Okay. Revaluating upwards will bring an increase in gains from revaluation, but they are part of the other comprehensive income statement. They are not part of the income statement. That means that you calculate net income, and after net income you start to add there all the not realizable gains from transaction. That means that these transactions are bringing some gains, but they are not realized really, currently, actually. Revaluating the land upwards doesn't mean that you are selling the land now. And that means that this gain is not realized and you cannot be taxed with that. Remember that the net income is an income that is affected by the taxes. You have to pay taxes for that. But this revaluation transaction is something to comply with the accounting requirements. This does not mean that you are really having 1 million of euros more because you are selling the land. No, you are not. You are just revaluing it upwards. You are not realizing this gain. You are not getting this money. So you should not pay any taxes for that. What is the solution to not pay taxes for this unrealized transaction? You first calculate the net income, and whatever brings other revenue that are not realizable and you should not pay taxes for, like the revaluation reserve, you add them below the net income. That is other comprehensive income. All of you have analyzed your companies in the group project, and you, correct me if I'm wrong, you have noticed there is a statement with the title Other Comprehensive or Total Comprehensive Income Statement. Have you ever thought about the items there? These are all items not realized by the company. They are included to show the increase in the value of the assets according to the accounting perspective and the accounting point of view. But the company is not actually taxable for that result. And this is something that, yes, will bring some income, but not net income, other comprehensive income. And that are revaluation reserves, changes in the conversion rates, whatever money you have, not in euro, but for example in dollar or in British pound, and they fluctuate, the exchange rates in the market, they fluctuate. You may have gains or losses from the changes in the exchange rate. That does not mean that you are actually cashing in the gains or paying out the losses from the exchange rates. They are just to reflect the fluctuations. That means that the changes in the translation reserves from the exchange rates is also a comprehensive income. Okay, so please remember, net income is before dividend and before other comprehensive income, like the revaluation reserve. That is, net income is not affected. Basic earnings per share will not be affected, and also diluted earnings per share will not be affected. Okay, So this is like an answer that we can give to this situation. Let's see the last one. It should not be difficult. On 31st of December of the same year, so that is the ending of the period, the company made an interest-free loan of 3 million to a charity and recognized this amount as a financial asset. The charity will repay the money on 31st of December 2024. Market rates of interest are 5%. Now, I recognize that if you don't understand point 2 here, it's very difficult to understand point 3, but I'm just giving you 1 minute to think over that. If you have any idea, yes. If you don't, I'm just taking that out of our illustrations. It's probably too advanced. Just read that.
Financial instruments. IFRS 9, IAS 49.
No, I mentioned it there. You have already
Just mentioned.
Yes,
Yeah.
already
Yeah.
mentioned.
Okay.
Also for one point thing, we don't know that was other comprehensive income statement.
Susan?
We don't know for today. We don't know that we're evaluating the growth in other comprehensive.
我只知道那个是部电影，
对
不能记得那个。We just know that it's a game and we don't know where we put it.
Okay.
这就是应该有教授讲英课是最好的。
它讲的比较细，不是就是
Okay, we'll do
算
like
法
that.
计算。
Maybe these are like, maybe this is going, okay, this is part of the curricula. Of course, it is assumed that you have been studying these standards before in the first part, and I just assumed that you knew the accounting treatment and the representation in the financial statement. So I'm just considering these minutes lost and not fruitful. Forget about point 2, I'm putting that in red. Together with point 3, forget about them. You are not required to learn about this stuff. So I'm just considering the last 15-20 minutes as a long discussion between us, but nothing for you to take out of that. If you want, you can memorize that it's other comprehensive income. If you want, you can know that the proper classification of financial instruments requires you to discount or calculate the present value of future cash outflows. That means that you will have a lower value of actually 3 million. Discounting that into the present for 3 years with 5% according to the time value of money. But that is probably something beyond of what we can teach and share by the end of the course. So that of course would decrease the net income and also lower both ratios. But again, please disconsider and disregard what we said in the last minutes together. Probably this is beyond the contents that you can apprehend and absorb right now. Okay, let's keep and go at exercise 3. We have 2 entities. They are identical in all respects, except for the application of IAS 16. Again, I'm sorry, but this is easier. IAS 16 here, it's going to be easier to explain. And also very useful to see the difference that the accounting method and accounting principles applied differently by 2 companies, the impact on the financial ratios. So we have 2 companies, they have everything the same. The only difference is the way that they choose to account for the property, plant and equipment. Company A accounts using the cost model. Okay, the cost model means that I will have historical cost less depreciation, accumulated depreciation, that is the carrying value. And I will put the carrying value in the statement of financial position. Whereas entity B uses the revaluation model. The revaluation model means that I have to revalue the assets linked to the fair value. Remember the previous example that I told you to forget, but forget altogether. So revaluation model means that we have to link the value of the assets to the fair value with the market, and therefore usually the revaluation model will bring higher value of assets compared to the historical cost. Okay? So property prices have risen recently. That makes us think if the property prices in the market have risen, that is, the fair value of entity B is revalued upwards continuously, whereas entity B, having the cost model, has been depreciating its assets. So both of them are going into different trends. Entity B is going up, is increasing the value of the assets to follow the increasing trend in prices in market, whereas entity A is decreasing the value of assets to show the depreciation each year, because this is what the cost model implies, okay? So keep this in mind, the two entities, because they have chosen different ways, and both ways are allowed under IAS 16. We are not breaking any rule here. We are fully complying to the standards. But because of complying in different ways, one of the entity is reporting higher values to reflect the increasing of prices in the market, and the other entity is reporting decreasing amounts to show the depreciation over years. So we have the performance statement. You see that the revenue is exactly the same. We said that the companies are the same, except for the way they choose to represent their long-term assets. The operating costs, remember, including depreciation, they are different because the difference in operating costs is related to depreciation only. Because the entity B follows the revaluation model, the amount of the depreciation that it calculates related to a bigger amount, a larger amount, of course will be larger than the entity A. The entity A still has for example, the building with 5 million euro of 10 years ago, and the depreciation will be lower related to that of entity B that values this building with 50 million euro as the fair value, and of course, obviously, the depreciation expenditure will be higher, okay? So that makes the profit from operations from both entities be different. Not because the entities have a change in performance. The revenue is the same. The expenses is the same. The only change, the source of difference, is the treatment of assets and the depreciation expense. Okay, so nothing actually different, only the treatment and representation of the assets in the statements. Now, regarding the statement of financial position, we have also the same information for both companies. You see that the share capital over here is the same, but we have a change in retained earnings. Why is that so? You see the difference in retained earnings is 30,000. Company A has $30,000 or euros more than company B. Why? Because it is also reporting higher profit, because it is reporting lower depreciation expenditure. So basically the companies are at the same position, the same performance, the same activity, but one is reporting higher net income for the year and higher retained earnings accumulated over the years, because it has charged less depreciation expenses over the time. Okay, another item over here to discuss is other items of equity. This is the revaluation reserve. That makes more sense to put in the brackets, revaluation reserve. At least you have seen this in the financial statements, right? That you have analyzed in your cases. So other items of equity or the revaluation reserve that the company B, choosing the revaluation model, has accumulated over time is reported in this item. The total equity is the sum between share capital, retained earnings, and other items, exactly the revaluation reserve over here. Then we have the liabilities, and the sum of total equity and the liabilities will give us the total equity and liabilities. So again, we have selected information from the income statement, performance statement. And we have some selected information from statement of financial position over here. We are required to use the ratio analysis to compare the financial statements of A and B together and explain how the differences may impact the stakeholder perception or the investors or the analyst perception. Now this expression over here using ratio analysis is very vague. What do you mean about ratio analysis? There are like 20 ratios I can calculate, okay, but you cannot calculate them all. Using the data that we have here, I know that you can compute and calculate at least 3 different ratios for both companies. So I'm giving you 5 minutes, identify 3 ratios that you can calculate, and then we compute them together, okay? Having this information, you can calculate 3 ratios. That you have the data over there, so just don't be too creative. You have the information, just use it. What can you calculate? For example, you cannot calculate the current ratio, right? Current assets to current liabilities, no way of having that information over there. But you can easily calculate, for example, a solvency ratio. Liquidity is not possible, but solvency is. So the first solvency ratio that I mentioned is total debt ratio, total debt to total assets. We can calculate that. Let's see what it brings out from both companies. Something else that is possible. Excuse me?
Debt equity ratio.
Yes, we can calculate debt equity ratio. I'm trying to keep the number of ratios at the minimum. So just 3 most relevant, because I would add many, but 3, I think 3 is enough. As we have evaluated solvency with total debt ratio, try to mention something out of profitability ratios. Can we calculate something out of there? Profitability, sorry?
The efficiency ratio,
The efficiency ratio. We are lacking,
the operating expense.
okay, but better than that, why don't we use the profit from operations that we have here? Remember that the profit from operations is nothing else than the EBIT, earning before interest and taxes. Can you calculate something using EBIT and something here? Yes, okay, good. So return on assets, that is earnings before taxes compared to total assets. Good. Okay, I will need another ratio, please. That is important. This is why I'm insisting. Something else that you can calculate. This is something that I mentioned. It's always useful to compare companies together to understand the efficiency. Return on capital employed. Yes, we can do that. but we are lacking the amount of interest to adjust the earnings. So having ROA, I'm sacrificing return on capital employed with your permission. I'm looking for something else. We have ROA, we are skipping ROCE, the same as we have total debt ratio, we are skipping total debt to total equity, but still we are lacking one ratio from another asset turnover. Actually, that's not a bad idea, Adela. This is not what I was looking for, actually, but that is, yes, that is okay. We can include that. So the total assets turnover, that is sales, revenue, to total assets. Can you, Adela, please calculate, Adela? Can you please calculate what the asset turnover is for both companies? Thank you. Another one that I'm insisting is important. Come on.
EBITDA. EBITDA.
EBITDA.
It's not possible.
Yes, that is very good idea. And I'm learning from you as well, not only from me. EBITDA is a very good indicator.
Compare the company.
The problem is that we don't know the exact amount of depreciation, because this includes depreciation over here. If I was given the depreciation separately, that would be optimal. Thank you. Sometimes we have very good feedback and insights from the students, and this is the thing that I like the most from teaching. One suggestion or one question from the students may also teach us new things. EBITDA is a very good indicator, actually. And analysts use that very much. Something else that we can use, come on. Something that I've mentioned is of extreme importance to measure profitability and performance, but staying inside the income statement, not combining two statements together. That is the profit margin. I'm sure that I have mentioned profit margin a lot during these days. So in this case, we can actually measure the operating profit margin. And that is useful to see and compare the operating capacity of two different companies. Operating profit margin is simply the ratio between EBIT and the sales revenue. Always the margin is the ratio between some level of the profit with the sales revenue, okay? So these are the actual ratios that we can calculate related to the two companies. We are now having a break of 5 minutes, which you can use to calculate these ratios, and then we will discuss after the break, okay? So let's have the data and have the comparison then between the two companies. 5 minutes break. Thank you.
Did you discuss about this yesterday? Okay. Yes. But I think that the contract almost the same. This is
Si ricorda tutto.
expression. And the price is also increasing, but not compared to the past So you can say that the market is after valuing the share, you can tell that the market is not very fast to reflect the trend of increasing earnings per share. Sometimes if you check a little bit later, you will see that the market has been adjusted because it takes time to investors to reflect and to act.
Ora, esatto. Perché non abbiamo tanto tempo. Prima pensavo fosse esatto. E poi le cose. No, meglio per me prima, poi studiamo le cose, spero di sì. Mi spiace. Meno male quando ho studiato le cose del ratio del gruppo le ho scritte in no, esatto.
Sono con lei, mi dico a me.
Ho appena tolto la parte di c'è anche quella outline, non so se
I don't know if we are going to make it at 3 o'clock. If we are done at 3 o'clock, I would like to take 1 hour for your questions if you have any questions. Whatever I decide to do, for example, I decide to solve an exercise, I will put them on the so it's not something that you are supposed to miss. You can use the day.
On the morning we have a lecture in the
Possiamo saltare magari non ce n'è nemmeno.
But I have to use the 1 hour to cover
So we have 3 paper rows.
我们是往后要开始了。你们最后决定今天试还是明天试？
啊，
你们最后决定了吗？
中午就不见面。我们本来想着今天中午，现在排一下。
So taking questions are being asked by different students about
但是我
tomorrow.
不弄了，
Of
我们
course,
准
we
备
are
晚上。
divided into 2
所
different
以我觉
sessions
得
for
现在也
presenting
太急。
our group work. We will start by 9 o'clock, but we will start the presentations only after 9:45. So from 9 to 9:45, I will most probably continue to discuss something that will be left not discussed from today, as I can see. So tomorrow morning we'll have to use the time to continue learning new things. I know that probably you won't be very attentive because you will think about your presentation, and I'm sorry about that, but we have to use the time. Then we start at 9:45 and we finish the first session at 12:30. That means that the groups that are going to present in the morning are not obliged or required to stay in the afternoon. You can leave. Then we'll resume at 2 o'clock with the rest of the presentations. And the same thing is true about the groups that will present in the afternoon. They are not obliged to come in the morning only for probably one exercise that I will be able to cover and solve tomorrow morning. You can follow online anyway. So I'm just encouraging to leave the room and space for the other students. Those that have to present in the morning can come in the morning and then leave. And then those that have to present during the afternoon, they can join us at 2 o'clock, but probably you are going to be here earlier, as I heard you have to maybe discuss with Professor Busa the results of the first exam, something like that. So probably you want to join earlier. But still, we start at 2 o'clock. We are scheduled to finish at 3 o'clock, but I don't know if we can abide to that schedule. I'm not sure about that. So maybe we can discuss something in the afternoon as well about the exercises and cases. In any case, everything that we will try to cover and explain will be posted on Moodle, and in any case, you can follow us online. Okay? So tomorrow is going to be our last day in class. Then Monday, one day before the exam, we'll have a tutorial session in the afternoon to make a recap of everything before the exam. That will be also an occasion to clarify any question you might have regarding different exercises and so on. Is that clear?
Will be online, so Monday.
Monday will be online. And also the exam will be on Moodle and online, either by the here in the premises of SA or those that have chosen to be online, you will have the full information posted on that. Okay?
Professor, can I ask that tomorrow morning for 1 hour, is it okay to put it all together in the afternoon so that we can just prepare our presentation in the morning?
That would require the change of many groups, and I'm afraid that many of you have already arranged our other engagements.
No, I mean just we start from 10, we come here to
Okay.
10, but in the afternoon, the 1 hour we combine into the afternoon lesson. Is it okay?
We can do that, but I'm not sure in the afternoon, if in the afternoon we will have time left. As I'm saying, usually the presentations require more time, so I'm not sure if we are going to end at 3 o'clock. So most probably in the afternoon there will not be any exercise. Some of you will be tired, and probably we will just skip that. But in the morning, even though you are not attentive, you are still fresh, so we can learn something in the morning. So I would prefer the morning about that. We still have Monday session to summarize everything or to clarify any doubts. Okay? Any other questions? Good. So, did you do any attempts to calculate the ratios over here? The total debt ratio, company A to company B. What is the total debt ratio over here? I don't have every data, every possible value. That's why I'm asking you.
41%.
41%?
42, you mean?
Okay, and company B?
24.
24%. Now that's a big change, right? We have two companies. Otherwise, they are exactly the same. They are identical, and especially they do not have any difference regarding the amount of debt or the loans. The debts are the same. The liabilities are the same between them. You see, liabilities are 100,000. It's not the case that one company has more liabilities than the other company. But the ratio, if we don't look at the data, we don't look at the income statement or statement of financial position, but we just look at the ratios, we might get the wrong idea. We might think that, okay, company A is getting too many debts or too many loans. Of course, this is within the 50% optimal rate, optimal value that we want from this ratio. But looking only at the ratio, we might wrongly think and get the idea that the company A has double the amount of the loans of company B. That is not the case. The amount of the loans and liabilities is the same. What causes the difference is the amount in the total assets over here. And exactly the approach the company has selected to disclose and present the long-term assets. Okay, so this is the reason why one company may appear more risky than the other company. So in the same time I'm commenting, I'm putting some comments and some words over here. So the first thing that we observe is that company A may appear more risky if we refer to the total debt ratio. But that is not the case. The reason is that we are showing more assets for company B rather than company A, and that has nothing to do with the loan and debts or the total debts or the risk or the solvency and so on. So something that we may understand is this one. It may appear more risky, but be careful. Now, this is an excellent example to teach you that sometimes ratios distract your attention from the reality. So ratios are good to use and to comment and interpret, but sometimes they divert your attention to wrong results and wrong conclusions. So please be aware, you calculate something, but then go back to the financial statements, check again the value, and the amount disclosed by the company, what does that say to you? Is that consistent with the ratio that is calculated? Remember the limitations of the ratios, okay? We mentioned that together. Something else that we may calculate is the ROA. We said EBIT compared to total assets, of course. And if we perform the calculations, I did that while on the break, it's 16.7% for A and 2.4% for company B. Okay, something else. Company A may appear more profitable than company B. Also, being here, discussing about the profitability, I would like also to calculate and present the operating profit margin because both of them relate to the profitability. So operating profit margin, EBIT considered and compared to sales, I also got that. It's 18.2% for company A and 4.5% for company B. Both of them show the same thing. Company A appears to be more profitable, and that is simply not true. They are exactly having the same results over here. The same revenue, the same expenditure, other than the depreciation. And why are we emphasizing? Remember, the depreciation is not a cash outflow. It's not an expenditure that will actually require the company to pay something. So having the depreciation impact so much the appearance of the profitability, that is something not to be skipped or to be not being discussed right now. Okay, so be careful. This is just the appearance. This is another excellent illustration how the ratios may lie or may be deceiving and may be misdirecting our attention. Okay, so we said that. What about the total assets turnover? Somebody mentioned this ratio. I hope you had time to calculate that.
92%.
92%, thank you. And?
52%.
52%? Okay. Remember that usually we want this ratio to be around 100% at one time. So usually we want for the companies to generate as much revenue as they have been investing in assets. But having these values, they are so very different from each other. Company A appears like it has turned over, or it has circulated, it has used, is the best word here, it has used the assets more efficiently. But again, that is not true. So this means that having a higher ratio of turnover, company A may look like it has used more efficiently the investments in the total assets, whereas company B is not able to do that because it has invested in assets and it's generating only almost half the amount of assets in sales revenue. But again, that is deceiving. If you go and see the data over here, you will see that the revenue 220 also, but what increases so much the total assets amount of company B is the revaluation reserve. You see that only the revaluation reserve is almost the amount of the total revenues. So this is again something to be attentive to. Now this is something that is enough to provide us a solution for this case. And to summarize what we discussed, there are two things that I would like to pinpoint and to take out of this example. The first thing is that a simple change in the accounting method for two identical companies may cause such a different picture for them. You see that they are almost at the extreme of each other regarding the four ratios that we are presenting there. Again, they are identical. They change only in one thing, in the way that they have chosen and selected to show and represent and disclose the assets in the financial statements. This is the first thing. And the second thing that we can take from this example is that sometimes financial ratios may be deceiving. So please go back to the source data and check again. Is the information speaking the same language and telling the same story as the ratios over there? This is a typical example where this is not true. If you as an analyst would not double check the financial statements, but would be enough with the information presented here, probably you would give the wrong suggestions to your clients. If you were a financial analyst analyzing companies and would suggest and advise your clients which share to purchase in the stock market, you would probably select company A, most probably, but that is not a good suggestion or a good advice, because you need further data to analyze the companies because they are almost identical to each other. Okay, I hope that that makes sense and also makes us realize that financial ratios are not perfect, and therefore we need non-financial information to complement our analysis. Okay, here we have Laura. She's a financial analyst, and she has identified several items in the financial reports of several companies. They are hypothetical, they do not exist in reality. Describe each of these items in the context of financial reporting quality spectrum. I just want us to decide if this is low quality or high quality of financial reporting. Remember that if there is any incentive to manage the financial statements, that means that we have a low quality earning amount reported in those statements. So let's have the first case and try to understand something about that. The company ABC the earnings totaled 233 million. And these earnings, consider that to be the net income. Probably the word earnings may be misleading for you. So this is the net income. That includes 100 million euro gain from selling one of the less profitable divisions of the company. Now, the earnings of the company from the 3 prior years were respectively 120, 107, and 111 million. The company financial reports are extremely clear and detailed, and the company's earnings announcement highlights the one-time nature of the 100 million gain. How would you interpret and how would you consider the reporting quality of this company? Is it high quality, low quality? Is there anything that company is trying to hide in there? An incentive to manage the earnings? It's not difficult. You are Laura, you are a young employee, you have to keep up with your position and make a good impression to the company. So give us an opinion. What do you think about this case? We have a company reporting 100 and something million profit, and in 1 year it jumps to 233 million. It almost doubles. But 100 million comes from one-time gain. Remember that this is not a recurring transaction. This will not happen anymore in the future. I'm selling this division now, and in the coming year, I'm not able to sell it again. So this is a one-time gain. It's not recurring in its nature. It will not be repeated. Okay. So we have the case here of high quality earnings. Why? Okay. Even though the earnings figure includes an one-time non-recurring gain from sale of divisions, Okay, this is really important. I think that several of you might have noticed that. It is very important when the company is really straightforward and really honest about the activity and explicitly states these changes, unusual changes, abnormal, non-recurring. It states that in the notes of financial statements. And here we have that this piece of information, which is really very important. Okay, the company is not trying to capitalize in non-fair way out of this one-time transaction. It's not that the company is trying to say that, you see, this year our activities have outperformed the expectations that targeted. We have realized on earnings that has been doubled since the previous year. The company actually is reporting very high quality earnings because it explicitly explains what is going on in there. So again, we have high earnings, but this includes earnings from sale of these assets, okay, and this division. Do you agree with what I already stated there? Are you okay with what I said? Anything else to add? Think better. Would you like to add anything else? Now you are not Laura, you are the CEO of this company. And you as the CEO have decided to be very honest and straightforward and to disclose that the earnings of this year to 33 million, they include 100 million gain. Why did you do that? You are the manager, you won the big bonus, and you got the big bonus for this year, but also you want something else. You want to have a steady amount of profit, so you don't want to get the expectations of the market too high. That means that if you didn't disclose this piece of information over there, the expectations of the market would be that in the next year you would be reporting a higher amount of earnings than 233 million. Why? Because the market expects you to perform in a steady increase, constant increase of earnings. So you are smart enough to have the bonus for this year, but to not raise the expectations of the market by stating that, be careful, we are doubling the earnings, that this is one-time, non-recurring transaction. Again, this is the incentive and the motive of the managers, but it does not change the truth. This is high-quality earnings. Everything is included in there, okay? And disclosed and explicitly stated on behalf of the company. Have a look at the different situation over here. We have this company that discloses that in 2019, it changed the depreciable life of its equipment from 3 to 15 years. Okay, I may change the useful life of this asset from 4 to 5 years because I see that it is performing well, but we extend from 3 years to 15 years. Well, to me that is a little bit suspicious. I don't know about you, how you will think about that, or Laura over there, but that represents actually a substantial component of the company's assets, these equipments. The company's disclosures indicate that the change is permissible under the accounting standards. We are not denying that. IFRS also allows the restatement and the adjustment of the useful life of assets. It does not prohibit the change whenever the managers feel that this represents the true benefits from the asset. They can do that. But would you say this is a high quality or a low quality earnings amount?
Maybe low.
Why?
As they change the useful life, the depreciation will decrease. As we can see, the profit maybe looks better, but maybe in the real life it's not better.
Low quality amount because even though the change is permissible, the company, the first thing the company does not do is the company does not explain why it has extended the useful life of assets. What is the motive? Did anything happen? Did you make any maintenance to extend the capacity of the asset and therefore to justify the useful life increase from 3 to 15 years? What did you do to justify this thing over here? So no explanation at all. I've noticed that also in your cases, in your presentations, there are many companies that make changes and do not give information. That is low quality earnings and low quality financial information, okay? So know why that happened. It is allowed, of course, it is permissible, but that does not mean that you should not provide further information. That is one reason, and remember, the other reason that is low quality is that this is not something that is not important or immaterial for the company. That is material information because this equipment represents a substantial component of the company's assets. And I may think, why exactly this piece of equipment suddenly is going to be used not 3 years but 15 years? Why not the other piece of equipment, which is less substantial, less important? So this is another source to be doubtful and to have suspicion for this case. So it relates to a piece of PPE that is material and high amount. So it represents a very material item that has a very huge impact in the financial statements. So this is like the reason that I would state the situation implies low quality of financial reporting. Now remember something, it's not necessary to just use and apply IFRS. The way that you apply the international financial reporting standards and the disclosures and the explanations that you are willing to give and to offer and to provide, they tell a lot about the quality of the financial information. How open and transparent you are to provide this information. Okay? So we have another case over here. We have these company expenditures. For the past 5 years, we've seen the R&D via research and development. R&D expenditure, I guess you know that. For the past 5 years, we've been spending approximately 3% of sales on new research and developing new products. For some kind of companies, for example, biopharmaceutical companies, it's very crucial to keep the amount of R&D expenditure at a certain level. Declining or decreasing the amount of R&D means that the company is not spending enough to research and to develop new products, and probably in the future it will suffer the consequences of not having new products introduced in the market, if you get the idea. Okay, so in 2019, the company significantly reduced this amount of expenditure. Without the reduction, the company would have reported a loss. So if in analysis I would continue the same trend in the percentages, structural percentages of R&D, that means that if in 2019 the company would have recorded the same percentage of R&D expenses, 3% to sales, actually it would have reported a loss, not a profit. And furthermore, no explanation is disclosed. That is pretty easy, but please can you give your own opinion with your own words? That is for a change from me. Do we all agree that it is low quality? Low quality of earnings, otherwise there would be no earnings at all, otherwise we would have a loss, okay? So low quality of earnings for one reason. What is more obvious, the first reason is no explanation. Usually, as I said, these kind of companies are companies for which it is very crucial to spend on R&D. If they don't do that, the current performance is not usually affected, the current year but the other years are going to be negatively impacted. If you don't spend to research on new products now, in the next year you have nothing new to introduce to the market, and your sales will suffer. But again, the impact is not immediate, it's not in the same year when you reduce the expenditure. The impact usually will happen later. I think it is obvious. So first of all, you give no explanation why you are spending less in R&D, which is very crucial for your activities, and that is a first source of suspicion. And then remember that R&D is what we call discretionary expenditure. If you remember, the discretionary expenditures are expenditures that are at the discretion of the managers. The managers can decide when to do or not to do this expenditure. And not only R&D, I'm adding some other items for you to be attentive when you read about them. Another item is repair and maintenance. Repair and maintenance, and another item yet is advertising. Again, why we call that discretionary expenditure is that they are at the discretion of the manager. If the manager doesn't feel like spending a lot in maintenance, he doesn't do that. He can have a look at the result, and if he can feel that, okay, I'm spending a lot in other items and that would make me report a loss, I better don't spend on maintenance, I better don't spend on R&D, I better don't spend at advertising. So he has the possibility and authority and the power to keep or withhold this kind of expenditure. And also, to his benefit, withholding this kind of expenditure now will not impact the performance of the current year, will have an impact later. Not spending for R&D now, we explain. Not spending for repair and maintenance now, okay, the equipment will continue to operate okay for some more months, but then they will go broke, they will go down, they will have problems, and you will need to spend even more to repair them because you have not regularly spent to maintain regularly these items. Also the advertising, if you don't pay the commercials now, you will not be able to sell in the future. So have an eye always on these items and have a look if the managers are trying to manage the earnings through withholding the discretionary expenditure. Are they not spending enough? Because probably they are trying to get the bonus now, and then they will go out of the company. When the trouble comes, they will not be there anymore. They will just reap the benefit of their very good performance, going to another company with higher salary. This is something that really happens. So we have to keep an eye on this kind of reality. Okay, is that clear? We can have a look at the exercise 5 right now. Of course, this is something also related to the quality of financial information. For each of the scenarios, we have to identify if there are any factors that might motivate and push the managers to manipulate the reported financial amounts. Let's have a look at the first one. ABC is a private company, and one certain bank has advanced a loan to this company. Now, the company is required, and this is important, is required to maintain a 2 times interest coverage ratio. Remember that sometimes the debt covenants, the debt contracts imply meeting certain criteria, certain thresholds. So this is the threshold that the company should not fall lower than. In its most recent financial report, ABC earnings before interest and taxes were 1,200,000 euro, interest expenses 600. But we have this disclosed in the report, in the annual report note. So this is the critical ratio that we should be very careful to keep at a minimum of 2 times. So okay, let's have a look. How much is it according to the reported values? So if the bank does not have a very attentive analyst, credit analyst over there that monitors the company financial statements, the credit analyst, if he is not very attentive, he would say, okay, what we have here, the earning before interest and taxes is 1,200 euro, divided by, okay, interest expense is 600, that gives me an interest coverage ratio equal to 2 times, right? So everything is okay. Let's go on with our contract together, bank and company. But if the financial analysts of the bank, they are known as credit analysts, they monitor the companies that have credit contracts and they keep an eye on the performance to have some signal of possible risks. So having an annual report of 200 pages is not easy to follow, but these credit analysts, they are trained to look for red flags. So one of the red flags that should always be checked if the company has unexpectedly extended the useful life of the assets. Now, if you extend the useful life of the asset, the depreciation expenditure will be lower, thus increasing the net income. If you reverse the effects of this transaction, it is said here that if this was not adjusted, if it was not expanded or extended, better to say, the useful life of the asset, the depreciation would be 150 euro lower as a result of this change. That means that if we have a depreciation expense lower by 150, we will have adjusted over here interest coverage ratio will be equal to the adjusted EBIT calculated and compared to the interest expenses. Okay? So again, if we are having, without extending the useful life of assets, we would have the same amount of depreciation as before, that would be 150 euro higher, and that means that our profit would be lower by 150. 1,200 less 150, that difference is what I need to compare with the expenditure. Okay. If we make the calculations right here, I don't know what is the value. Thank you. 1.75. Okay. Good. Do we have any motive? Sorry?
75.
Okay. You know what is the biggest, not the biggest, the most usual mistake that the accountants do, right? Is the inversion of the numbers. Adding or not adding zeros and displacing the numbers. This is like the most common mistake. Okay. Do we have any motive here to change anything? Or not? Yes. Obvious. We have different incentives we mentioned during the lecture. Incentives that come from contracts with shareholders, contracts with creditors, that issuers or loans, and contracts with employees. This is the case when we have a problem or some constraints coming from the contracts with the debt. So this is the constraints related to thresholds or criteria included in debt covenants. Okay, good. We have something else over here. Are you tired? A little bit? Do you think we can make the other 2 exercises? Okay. Yeah, tomorrow morning, of course, but I had a very, okay, I had prepared a list of things that I wanted to discuss together, but we were walking a little bit slow this morning, so let's do it like this. Exercise 6 and 7 we will cover tomorrow morning because they are important. Now we discuss the situation number 2, and then I will just show for you a simple case. It's pre-solved, just to discuss something together for 2 or 3 minutes, and we are done for today. Is that okay? Tomorrow, fresh, you will be able to comprehend the non-financial information. Yes?
Can I ask you to please send the part 5 solution?
Tutorial 5?
Yes.
Yes, I wanted to upload yesterday, but I thought it was not complete and it might not be relevant, but I will do right now. We finish and we upload the materials. So you have time to study, right? Good. It makes me happy. Now, we have a company which is a publicly traded. The shares are listed in the stock market. For the most recent quarter, the average of analyst forecasts for earnings per share was 2.5 euro per share. In its quarterly earnings announcement, the company reported net income of this amount over here, whereas the number of common shares is also available. Just to not lose time, I will check if I have the calculated the earnings per share. Just a moment. Okay, I have ready all the calculations, so we'll not have a long time.
2.51.
Good. So it's 2.51. Again, we are dividing the net income to the number of shares. That's pretty easy because the company has made sure to report both of them. Good, but the company main product is a hardware device that includes a free 2-year service. Based on the management estimates, the company allocates a portion of revenues to the hardware device which it recognizes immediately and a portion to the service contract which it defers and recognizes over the 2 years of the contract. Based on the disclosures, a higher percentage of revenue was allocated to the hardware than in the past. Okay, the after-tax impact on net income is this one over here. What has happened? Let me explain briefly and in simple words. Usually these long sentences and paragraphs are normal part of annual reports. If you are like me, sometimes you may feel lost reading through them. Just try to understand what they are saying because they tend to use big words, yes, to make us feel smaller, but of course you have to go through to the substance of the transaction. Usually when you have a revenue over the 2 years, the standard requires you to divide the amount that will be recognized as a revenue for the 2 years. One part for the first year and one part for the second year. The way that it is divided between the 2 years is regulated through IFRS 15 revenues, and you have discussed about that. Now, when we go, without going into unnecessary details, when we see very carefully, we can check that the company has made some error, maybe on purpose, that it has recognized as revenue in this year 27,000 euro that actually belong to the year to come, to the future year, not to the current year that we are talking about. So, in not a consistent and correct way, it has displaced the timing of revenue recognition. 27,000 euro should be recognized in 2022, for example. Actually, the company has included that in 2021. So, can we do something to reveal the impact of this transaction over here? So, the adjusted earnings per share will be the ratio between the adjusted amount of earnings. That means that actually the net income is not this amount, but is a lower amount by 27,000 euro. And then the adjusted earnings to exclude and not take into consideration the not correct treatment of the revenue from this contract should be divided with the number of shares over here. So this is like the correct earning per share figure that we have to report and disclose. If we make the calculations, I don't know yet, I have it ready, so do not. That is equal with 2.49 euro per share. It is very interesting, like the change in the amount of the contract is exactly enough to make my earnings per share jump from 2.49, which is just below the threshold, to jump to 2.51, which is above the threshold and will not, hopefully, will not be cut and will not be observed, will not attract attention. So, of course, we have again some incentive to manage the earnings over here. And where does that come from? What is the reason why we need to manage the earnings? There is not any debt involved in there. There is not any bonus actually linked to the value of the earnings per share. Why should you, as a manager, risk your position and credibility and be identified as a person involved in this accounting cosmetic technique? Why would you do that? Sometimes this is a very killing source of pressure for managers that direct big companies. Usually the analysts publish their forecasts and they shape the expectations of the investors. And once the analyst forecasts are published, the managers really try very hard to keep up with these expectations, because otherwise the shareholders that have been shaped according to the analyst publications, they will be disappointed and they will abandon the company by selling the shares. So yes, what you are also writing in the chat, it is true. In this way, we can satisfy the expectations. Thank you very much for your feedback. So, as we said, we are done here today with tutorial 6. There are 2 cases very interesting to discuss tomorrow morning. But what I wanted to share right now with you, this is an example that will also be available. Yes, this is an example that will also be available in the Moodle. I will upload that in Moodle just for your information. So, we have a mini case over here. I like to share with you, the information is already completely provided, but I just wanted to make you aware that sometimes using the univariate analysis, that is using only one ratio, to analyze the company takes you to the wrong conclusions or to the wrong results, okay? So we have this company for 3 years, consecutive years, and I apologize that this year is out of control. Here is actually 2020. So the current ratio you see is constantly increasing over the time. And you see as well that thank you for the reminder. I think that you can see now. Thank you. So we have this company, we have 3 fiscal years, we have 2 ratios, current ratio. The current ratio is improving, that's good. But we see the quick ratio telling a different story. The quick ratio is declining over the years. So what can we say about the liquidity? This is a typical position and situation that we are confused. Okay, what is true after all? Is it the liquidity is better or is worse? Given 2 different ratios, they are both important. One tells a different story from the other. Where should I base my final verdict and decision? That is a typical difficulty for many analysts situation. Now the ratios present a contradictory picture, Based on the increase on its current ratio, the company gives a good impression, otherwise the quick ratio gives the opposite impression. Now, because both ratios have the same denominator, current liabilities, the only source of difference, it should be the inventory. So it is the inventory management, the item that I should be looking for and investigate further to understand what is really going on. So going back to the company and looking the inventory days and the debtor days, why should I care about the debtor days over here? I should look only the inventory days, we said, right? But be careful. If you sell faster, you will accumulate debtors faster. You can sell many items, but sometimes you are not able to collect money as fast as you sell the inventory. So always remember to connect together inventory and receivables, because they are in the operating cycle, they are phases after one another, okay? So the company inventory days actually are increasing from 30 to 55 days. That means that we are not able to sell the inventory. We are keeping more inventory in the warehouse, and we are not able to sell as good or as better as before. But then the decrease in the ratio of debtor days means that the company, in the ratio of debtor days, I will correct that, means that the company is collecting the receivables faster. And this means why the debtors' days have been improved. If the proceeds from these collections were held as cash, that means if I collect money from the customers and I keep cash, instead of using to buy further inventory, then either the current ratio or the quick ratio would have been affected of that. But however, if the proceeds from the collection were used to purchase inventory, as is the case in this example, there would be no effect in the current ratio, but would have, or we would witness a quick decline in the quick ratio, because inventory is not included in this indicator. So the inventory is not having an impact on that. Collectively, the ratio suggests that liquidity is declining, but the company may have an inventory problem as well that needs to be addressed soon. So a summary of the findings. First, be careful when you use the univariate analysis. Current ratio, quick ratio, different ideas, investigate further. One ratio might mislead our opinions, and you should complement the analysis with as many ratios as you can. Okay? I will post the mini case on Moodle so you can know how to proceed with the steps in analysis. It's not that you don't know, because you have already completed your group project work, so I guess everything is settled. Any question you might want to ask? Okay, we complete for today. We meet tomorrow at 9 o'clock to